So the number is 6.6% in May 2012 compared to May 2011, slightly higher than expected.
We were forecasting 6.5%, so I'm not really too disturbed by the fact that it was marginally higher than what we expected. If we look at the detail behind the numbers, it seems as if a large portion of the pressure that we saw were either electricity related or it came from commodity price increases. And of course, May was when the rand started sliding. So it is partly a rand commodity price increase that we're seeing here.
Of course, the rand has been very volatile. I mean, it's been between, in the last month or so, 3 weeks or so, it's between 820 and 860. How do these kinds of numbers reflect that volatility?
The way in which these numbers are compiled, Stats SA in many cases merely look at listed commodity prices, quoted commodity prices. Things like oil prices, quotes, other mining and metal commodity prices. And so you will see a direct, immediate impact of any rand weakness on these numbers, almost irrespective of what we're paying for imports and exports. These are merely the quotes that we see on the exchanges every day.
You say, well, the consensus was that this is slightly higher. You say it's not a concern to you. You were expecting 6.5. But in broad terms, is this good? Is this what we should expect? Maybe that's what was predicted, but is it where we should be?
I think at 6.5%, just more than 6.5%, it is still indicating that there's some pipeline pressure that will in due course filter through to consumer prices, which is obviously the focus given its importance for interest rates. But it is so close to the target range that I think it's really just supporting our view that the inflation outlook overall will be reasonably benign over the next 12 months. Some of the numbers that we haven't spoken about yet is food prices, of course.
Let's talk about that.
Absolutely a key story here. What we saw in today's numbers was a continued decline in meat prices in particular, again quite important for retail because it's about a third of the food inflation basket. And so because we've had drought at the beginning of the year, you're seeing increased slaughterings, prices coming down, and so it is providing a little bit of relief in terms of food prices and consumer
We
pressure.
need that. You know, it's like 30 rand a lamb chop at the moment. So I see the food index came down from 8.4% to 8.4% this May from 9.7% in April. So that's quite a quick drop month on month.
Absolutely. And if we look at the consumer price numbers, the retail food basket, we see that coming down from low double-digit rates to, we expect, less than 5% by the end of the year. So quite a sharp disinflationary cycle. And I believe it is partly reflective of a consumer that is under some pressure, in other words, not able to continue to pay high prices for these goods.
Well, food prices do fluctuate, as does the petrol price, but electricity is one price we can expect to keep going up. Now, the annual rate decreased there. This is, I think, the only number in double figures in this list, 21.3% in April to 24.4% in May. Is that of any significance?
I think we can look at it in two ways. One is that if we look on the month-on-month PPI, then it increased 0.5%, 0.2 of that was electricity. So clearly a large part of this pressure is coming from that, and it isn't really broad-based and therefore a concern from that perspective. But of course, electricity prices will directly impact on other prices as well and have a significant indirect impact. You've mentioned the more than 20% increase that we're seeing now. Of course, this year's price increase has been lowered to just more than 16%, and so that year-on-year rate of increase should come down to about 16% in the next couple of months. Looking forward, however, we know that Eskom is currently working on its new price application for the next 5 years, and I expect something between 12 and 15%, unfortunately, for another 5 years. So this is something that is going to be with us for quite some time.
Also, if at that rate of increase, I think 14% is the number that's being talked about over the next 5 years every year. Well, that basically means the price will double if you do the arithmetic.
And of course, it has done so over the last couple of years. Absolutely.
And the double counting, I mean, just to mention the electricity, there, a lot of the other sectors, presumably, that is related to electricity, manufacturers and so on.
Absolutely, yes. And we'll see the same thing at the retail price.
Sorry. Let's look at mining and commodities generally.
I think what we saw in the May numbers was to some extent what we think about as the sliding of the rand in May, while commodity prices were still reasonably high at that stage. So the currencies reflected the global weak outlook first, and then we started seeing commodity prices coming down. We think about oil that was still about $110, $120 per barrel, now about 90, just more than that. And so what we'll likely see in the June numbers is that a large portion of this will be reversed to reflect those price changes in June.
Then you've got exported commodities, the rate there from April to May increased by 1.1%. Over the year, it would be interesting to know what it is. And then for imported by 0.9%. What is the significance of those numbers?
I think we should think of this in terms of the terms of trade. In other words, if our exported commodity prices are higher or increase more than the imported commodity prices, it has a direct benefit for us. And what we saw over the last, I'd say, 10 to 12 years was a continued and very strong increase in the terms of trade, which was a very strong support factor for economic growth overall. So even though export volumes, for example, were very disappointing, export revenues were quite strong. And we need to monitor this very carefully because we have seen the terms of trade, in other words, those relative prices, starting to retreat a little bit, which would of course be a very negative for the growth outlook if that continues. But at this stage, still quite a support from a growth and trade perspective.
Your experience of PPI and CPI, the one, as it were, happens first and then it filters through to the next one. What is this going to tell us about the next CPI numbers?
I think the most important is to watch the food numbers. So I'm very encouraged by the fact that the food inflation trends are still disinflationary in these numbers, and that is something that we expect to see in the retail numbers in due course as well. Of course, Stats SA is revamping the PPI quite meaningfully, so by next year I believe we'll have a much more reliable PPI than what we have at this stage.
Let's do the old trick that I like, is the team they should pick and the team they will pick if we're talking in sporting terms. So what should they be doing with rate cuts in your view? Rates cuts or increases, and when? And what will they do?
I think in this case, I think they are the same. So I don't think they should, and I don't think they will cut rates. Yes. So I believe rates will remain on hold until 2014, and then we'll probably start seeing a very gradual rate hiking cycle, provided that the global economy is on a stronger footing by then. I do think there is some risk of a rate cut because of the improvement in the inflation outlook, particularly because of the decline in commodity prices, and because we're really concerned about growth, and we believe the Reserve Bank is as well. So the risk is there. But we think the Reserve Bank is more likely to try to keep rates on these low levels for an extended period and signal that to consumers and investors rather than to squeeze in another cut, which will be unsustainable.
It's already the longest level that at this low level that the rates have been on record. It looks like the record being extended for long. In the United States, they actually said they would keep rates constant, I think, till 2014. It looks like, in effect, we're going to do the same.
I think we will do the same. I think the Reserve Bank is slightly reluctant to paint themselves into a corner, simply because we are so vulnerable to what happens internationally. If Europe really collapses, we will have to cut rates, and you don't want to signal strongly that you are not going to do that and then be forced to do that at some point. So I think that's the only reason why the Reserve Bank is shying away from giving such signals, but I think in effect we're going to follow suit.